Stablecoins and tokenisation aren't future concepts. They're here to stay, and now under a regulatory framework that is giving corporate treasurers more confidence to actually begin using digital assets. Standard Chartered is one bank helping its corporate clients seize this opportunity to make Treasury faster, smarter, and truly global. I'm Sarah Rundell, and in this podcast, I'm joined by Standard Chartered's Jennifer Lassiter, Head of Digital Assets, Europe and Americas, to discuss how they are being used as Treasury tools. To hear more about Standard Chartered's global digital assets strategy to date, and get the lowdown on the US legislative and regulatory backdrop. We're going to talk, amongst other things, about US dollar stablecoins for corporate treasury, tokenized money market funds for intraday liquidity, and risk and compliance in the context of Standard Chartered's global strategy. So Jennifer, welcome. It's lovely to have you here.
Thank you, Sarah. It's lovely to be here.
Okay, so could you begin by setting the scene and outlining what comes under the banner of digital assets and which assets we're going to speak about today? Could you also outline Standard Chartered's digital asset strategy to date and where the bank has been most focused?
Yes, I'm happy to. But maybe before I jump into your question, Sarah, it would be good to give listeners a quick background on Standard Chartered. I think this background has situated the bank to be a leader in digital asset capabilities, so is particularly relevant for our discussion today. So, just briefly, Standard Chartered is a UK-based bank. We are a 170-year-old bank operating 120 years in the United States. We operate in more than 50 markets with a specific focus on Asia, Africa, and the Middle East. And our objective is to connect emerging markets to the global economy and vice versa. And it's because of that that we've had a front seat in digital asset building and application. So I'm very happy to be here talking about that strategy. So back to your question, which was what falls under the banner of digital assets. I think it's really important in this conversation to call out that often folks hear the term digital assets and they jump straight to crypto trading, which brings with it attributes of price volatility, headlines, or speculation. But in the banking and corporate world, digital assets actually refer to a much broader and much more practical universe. So, at the most basic level, a digital asset is simply a traditional financial instrument that lives on modern digital rails instead of the older settlement infrastructure that you and I, and probably most of your listeners, grew up with. So I like to think about a US dollar that you can move 24/7 in seconds anywhere around the world. And we would call that a stable coin. You can also think of an example of a money market fund that settles instantly instead of in a business day. And that would be an example of a tokenized real world asset. So we're not replacing existing financial products. We're taking familiar instruments and putting them on faster programmable infrastructure. Probably folks have heard a lot of times the phrase, we're modernizing the plumbing, but it's very accurate. At Standard Chartered, our strategy has been to build regulated institutional grade infrastructure. And we started with our ventures arm, as most banks do, investing in companies. Folks may have heard of Zodia Custody or Zodia Markets. These are two fully regulated entities built for asset managers, insurers, and corporates. And again, they're not doing anonymous retail trading. Our venture companies at Standard Chartered run a little bit ahead of the bank, and they're doing that to test commercial viability. They're also offering Standard Chartered a view into how to structure governance. And these are components such as compliance, know your customer, audits, cybersecurity, insurance and reporting, all of the requirements that make institutions comfortable to their respective crypto activities. At Standard Chartered, we're best when we learn from those investments and then bring core capabilities into the bank itself. An example of where we've done this is actually with Zodia Custody. So after several years of learning, Standard Chartered recently launched institutional grade digital asset custody services to our clients in the Middle East, Hong Kong, and soon to launch in Luxembourg. And then finally, we're working on modernizing our own internal infrastructure. Standard Chartered was an early investor in Partior, a blockchain infrastructure solution originating in Singapore. And we've recently incorporated Partior in a portion of our EU operations to facilitate tokenized deposit transfer. So that's a bit of a summary of the different ways to think about digital assets in a globally systemic institutional bank and how Standard Chartered has started to approach our digital asset strategy globally.
Oh, thank you so much. Super clear descriptions of what these assets actually are, and also of your sort of beginnings in venture and how the strategy is evolving. So how do these assets support the typical corporate treasury function, and to what extent are corporate treasurers integrating digital assets into their treasury strategies? How might digital assets support trapped cash or intercompany liquidity flows, for example, sort of common treasury headaches?
This is a great question, and it's been top of mind for our Treasury clients for a while now. And I would say, very, very simply, what our clients are looking for is speed, control, and certainty. And digital assets are starting to deliver all three. So I think it's very important to remember that we're at the beginning of figuring out how to govern and connect these new systems. And that is what will bring realization of the true efficiency of the technology. So you asked about examples that the bank is seeing, and I thought it would be helpful to give maybe three specific ones. First, I wanted to take a look at what our clients say is the most common pain point, which is trapped cash. You also mentioned in your question. If you operate in markets like Nigeria, Egypt, Pakistan, you might have US dollar earnings from sales, but strict FX controls or slow settlement times that make it hard to move that capital out. That ties up liquidity and hurts working capital planning. Very basic. With a regulated US dollar stablecoin, Standard Chartered has seen that corporates can move value again in minutes instead of days and without waiting for legacy clearing windows. So you're not bypassing the rules, you're using just faster infrastructure. Another example would be 24/7 Treasury, which you also mentioned. Businesses don't operate Monday to Friday, 9 to 5 anymore, certainly across borders. Global trade happens continuously. If a supplier needs funds on a weekend or a distributor needs cash, let's say in Asia, when it's the middle of the night in New York, where I'm sitting right now, a stablecoin transfer can let you settle immediately. So it would be the difference, let's say, between mailing a check or sending an email. And once you experience that speed, it's very hard to go back. And then the third example I wanted to give was around tokenized money market funds. So these are not speculative crypto products. They're the same US treasuries or money market funds that treasurers already buy. They're just represented digitally on the blockchain. And the benefit, again, can be instant settlement. So today, if you redeem before cutoff, you might get cash the next day. In a tokenized money market fund, you could potentially redeem in minutes. And so that opens the door to intraday liquidity, which we've never had before in traditional cash investing. And then actually, if I can, I'd love to provide just one more example because I think this one is quite relevant to this audience. And this is treasurers starting to use on-chain FX. So instead of sending fiat through multiple correspondent banks, they convert into a regulated stablecoin, they settle globally, and then they convert back into local currency. And this transaction will happen faster with full transparency. I mean, by transparency, clearer tracking, and often at a lower cost. So the message is simple, but kind of boring, but that this work is simply treasury modernization. It's freeing up working capital, it's moving money faster, it's reducing operational friction, and companies more control over their liquidity. But again, we're at the beginning and we are determining right now how regulation and governance harmony can happen. It is essential, but those two things are also very hard.
Yeah, yeah, so interesting, and particularly to hear about how digital assets are supporting corporates
Mhm.
with operations in emerging markets, how you described in that first example. So, how is the legislative and regulatory environment supporting the evolution of digital assets for corporate treasurers?
That is a very large question. And it's one that I get in every single conversation that we're having right now. So that can tell you alone that it's incredibly relevant and critical to really being able to see, I think, the full efficiency and benefits of the technology. If I look about, let's say, 10 years back, I would say regulation was the roadblock globally and sentence. This time last year, I would say regulation was still honestly a roadblock. We saw some movement outside of the US, but no movement within the US. And then today, I would say in many markets, including the United States, regulation has become the enabler. So we've gone from roadblock, semi roadblock to complete enablement. For listeners, that enablement has been spurred by the United States passing the Genius Act in July of 2025, so this year. For the first time, we had in the United States a federal framework defining what a compliant, fully reserved US dollar stablecoin issuer looks like. It requires issuers to hold safe, high quality reserves, such as cash and treasuries. Issuers have to publish disclosures and they have to submit to supervision. They cannot lend out reserves or run bank like maturity mismatches. And this gives corporates confidence that a dollar on a blockchain is truly a dollar, right? It's not an IOU. And that impacts Standard Chartered's corporate treasury clients. So globally, we're seeing regulators move even faster. Of course, before the Genius Act passed this year, the European Union's MiCA framework had already been in existence, and that created licensing for custody, trading, and tokenization across all 27 member states. A fun fact about Genius is that if you do a side by side comparison, I would say probably three-fourths of Genius is similar, if not the same, as the MiCA framework. Great example of iterative policymaking, meaning that we ship something in the EU, we learned from it, we ship something in the US, we built upon what was already in existence. And now what we're seeing are other regions, some who don't have any stablecoin regime framework in place, and some that do, looking at Genius and building from Genius. So those regions, for example, would be Hong Kong and Singapore. They have comprehensive licensing for stablecoins and digital asset exchanges. They are also taking under consideration the Genius language. And the UAE, of course, who launched a full supervisory model under VARA previous to 2025. And then they are looking to iterate on the existing model today as well. So we're seeing adoption accelerate in Asia, the Middle East, and Europe. Treasurers now have regulatory clarity with the United States regulation coming into play. And there are a few key components of regulation that we're still waiting for that will further enable this activity. So in the US, banks are still waiting on final supervisory guidance for how we can custody and transact with stablecoins on balance sheet. The direction of travel is very clear. The discussions that we're having are no longer if the banks will participate, but how and under which controls. And we're really excited at Standard Chartered to see the rule finalization happen probably towards the end of next year that will address these components. Um, Another component of having legislation out of the US is that it's really making a statement that digital assets are regulated as part of the financial system, not as a disruptive outsider to it. And once we are able to operate on chain under full regulatory supervision, I believe that bank adoption and ecosystem adoption will scale very, very quickly.
Brilliant. So turning to the risk and compliance challenges that come with digital assets, how should corporate treasurers secure and account for these assets? And is a digital assets policy for corporate treasurers important?
It is incredibly important. End sentence. The
Yeah.
most important thing I think to understand, though, is that digital assets don't eliminate risk. They just move risk to new places. So, what I mean by that is in a traditional world, for example, if your bank account is compromised, the bank has fraud controls, kill switches, recovery mechanisms, etc. In the digital world, the key that controls the asset is the private key. So if someone gets it, they can move the asset. Self custody, of course, has a purpose and a place. But for Standard Chartered's corporate clients, what they're looking for is regulated, insured institutional custody, which, for example, would be our custody platform and others like Zodia Custody. On the financial crime side, blockchain actually gives us more transparency, not less. And I think that's a bit of a myth bust that needs to happen frequently. Every transaction is recorded permanently, and companies need policies such as approved counterparties, whitelisted wallets, dual authorization for large transfers, clear accounting treatment. These are not complex innovations, they're just new. And a lot of the compliance and control requirements that we have in the traditional world still hold true for our digital world. Um, in cash management, of course, corporates are writing digital asset treasury policies right now, and many of them will look familiar. So here's a few examples for our listeners. Which assets the company is allowed to hold, who can authorize transfers, how assets are custodied, reporting and audit processes, and limits to manage risk. So once these controls are in place, Treasury teams tell us the same thing. This feels like a new payment rail, not a whole new asset class. So the message I think I want to leave with this question is that digital assets become safe when they're institutional, regulated, and policy driven. That's exactly the environment banks operate in the past, today, and in the future. And with legislation and regulation globally, we're starting to see the roles and responsibilities for the stakeholders across the digital asset system shake out, and banks play a very critical role, particularly for our compliance and risk components.
Oh, thank you so much for that. So that
Mhm.
leads nicely into our final question. What does next year hold for continued evolution in this space?
I think 2026 is going to be a very big year globally. Um, we're definitely entering the institutional scale phase, is what I would call it. For the past 5 years, the space has been dominated by fintechs and early adopters. And I'm proud to say also Standard Chartered. We had our first digital asset investment happen almost a decade ago, actually. I think the next 5 years will be led by regulated financial institutions. So these would be banks, asset managers, insurers, and global corporates. And I have already started to see that shift. In London this year, Standard Chartered announced Bitcoin and Ethereum trading on our institutional FX desk. Again, a signal to the market that these assets are moving into mainstream banking channels with compliance, reporting, and market making, like any other traded product. With custody, the Standard Chartered platform and others like Zodia are onboarding some of the largest institutions in Europe and Asia. And the US is becoming the fastest growing region, especially for crypto exposed corporates, exchanges, payment platforms, Web3 businesses who need bank accounts, FX, US dollar settlement. So I see three big growth areas ahead. The first is institutional grade custody. So Standard Chartered safeguarding digital dollars, tokenized assets, and crypto the same way we safeguard securities today. The second is 24/7 settlement rails, which we touched on a little bit already. payments, liquidity, FX, this all happening in real time. And that will change how our clients' treasury desks operate and how working capital is planned. And then third is tokenized finance. So not speculative meme coins, but regulated money market funds, short duration treasuries, loans, and I think eventually security settlement moving entirely on chain. What's really interesting is what happens when these things start to intersect together. So institutional grade custody, 24/7 settlement rails, and tokenized finance. This together can create a world where corporate treasury can redeem a tokenized money market fund instantly, then use those dollars to pay a supplier immediately, settle FX around the clock, and reflect everything in ERP and accounting systems in real time. And I think this is not 10 years from now. I think we're already in the early stages of building out that capability today. So, zooming out, if I can, just for a moment, I think the big takeaways are that the financial system's becoming programmable, that money moves like data moves on the internet, and that banks like Standard Chartered are helping make sure that happens safely with full regulatory oversight and in a way that treasurers can actually use. So it's a really exciting time to be in this work, and it's an exciting time to be doing it with Standard Chartered, who again already has many live digital asset capabilities in the core banking functions as well as through our ventures arms. And I'm really excited to see that change is no longer coming from outside the banking system, but it's being built inside of it.
Yeah. Gosh. So certainly one of the most sort of exciting areas of corporate treasury ahead. Jennifer, it's been
Yeah.
absolutely fascinating. Thank you so much.
Thank you so much, Sarah. I really enjoyed this conversation and appreciate you having me today.
A big thank you to Standard Chartered's Jennifer Lassiter, Head of Digital Assets Europe and Americas. I'm Sarah Rundell from Treasury Today Group. Thank you for listening. And if you'd like to hear more of our podcast episodes, please subscribe wherever you get your podcasts from.